It's 2018, so it's 10 years since the great financial crisis. What's happened? There's been a massive influx of liquidity. Quantitative easing seemed to be the solution to all problems, and in some way it has. But all the liquidity has gone into asset inflation. So all-time high stock prices, depressed yields, dividend yields are going to zero. There's nothing more to sell, so volatility is being crushed. And the end result is not entirely what was expected, because the real economy has not really benefited from such a great amount of liquidity. Why is that? Well, maybe because with the great influx of liquidity, and given what had happened in 2008, 2009, there's been also an increase of regulation and a strong increase of capital requirements, especially for the traditional financial institutions. So this means that corporates are finding it harder than ever to access traditional financing solutions. And factoring, for example, which has always been a monopoly of banks and factoring houses, is becoming something very difficult to access for most of the corporates. Some corporates just cannot access it, some have limited access, and some actually are interested in diversifying and moving away from the traditional financial institution offering. So here we come, Velotrade. The company was founded in 2015. It's myself, Gianluca, and Emmanuel. So, and the idea was to create, the ambition actually is to create a new asset class, to create a marketplace, so that corporates and institutional investors can actually meet. Institutional investors are those craving for returns. They're looking for yield, and they can't find anything, especially on the short end of the curve. And on the other hand of the spectrum, you have corporates, which once again are desperate to finance their account receivables. They need liquidity to produce more. They have to wait to be paid, and by accessing a marketplace and an efficient distribution of liquidity, they could actually produce more and be far more efficient. So Velotrade started, of course you never wake up with a perfect idea, so it was the result of an interaction. Initially we were using our own capital to purchase invoices. Actually we were purchasing goods and issuing invoices. The next step was the idea of creating a fund which would actually allow investors to access invoices, and the final iteration, which is the final one, the one that we're working on now, is the creation of a platform and therefore a marketplace where corporates come, they give us their invoices, we evaluate the seller first, we run a very thorough KYC on them. Once they present us with their invoices, we actually validate the buyer, we insure the buyer, so offering layers of de-risking to our investors. We then verify transactions with the buyer and eventually put the invoices on the platform. And here's what we are different from a bank. We don't use our own capital to finance such instruments, but we plug in a network of investors. And our target is actually institutional investors. So it can be hedge funds, it can be asset managers, large family offices, and a bit, but not predominantly, high net worth individuals. So investors come to the platform, they actually see this paper, which generally has a maturity of anything between 30 and I would say 90 days, sometimes extending to 120 days. It's paper that's insured by a AA insurance company. It's paper that has been approved by the buyer. It's paper on which the Velotrade team has run a very thorough and extensive due diligence. So the product has a risk framework that is very palatable to institutional investors. So the institutional investor will actually purchase the invoice by advancing generally 70, 80, up to 90% of that invoice, and at maturity, when the buyer pays, the investor receives back the advance made plus a yield, and the end result is the investor makes a return which is extremely meaningful, and the corporate actually has access to the liquidity embedded in that contract within 1 or 2 days from accessing the platform, and so therefore can produce more, pay salaries, and basically increase production and improve his liquidity profile. So this is in a nutshell the workflow, and once again the ambition is to create a go-to place for investors and for corporates. And the beauty of the project, among others, is, especially when discussing such matters with regulators and government agencies, is that the ultimate goal is the one to funnel a lot of the liquidity that until now has been constrained into one of the sectors that is most important for the growth of an economy. So when we present our project with governmental agencies and regulators, it is extremely well received, because the ultimate goal is the one to improve the access to liquidity and therefore the funding rates, which once again at the moment seem to be rather out of line in favor of investors. So why is the project a successful one? Sometimes one has to sit down, ponder and look back. We could have been much faster, so sometimes we actually get a bit frustrated because we think we should have been further ahead given how long ago we started. But actually I think that is possibly the main secret of success, is actually creating foundations. So once again, the idea is a simple one. The implementation is tough, but why is it tough? It's tough because we have to make sure that everything works. And if you move too fast, especially in the world of fintech, maybe pure technology does not apply. So maybe a Facebook can afford to break everything, and if it doesn't work, hey, well, we'll start again. But when you're dealing with money, when you're dealing with large amounts of money, when you're dealing with the livelihood of the players on your platform, you do not have that option. There is no option for making mistakes. So you have to make sure that the legal framework is dealt with. You have to make sure that the whole technology infrastructure is a solid, efficient one. You have to make sure that all the legal agreements that govern the interactions of the players on the platform are correctly sourced. You have to make sure that you have the right personnel in place to be able to deal with the complexity. You need to have a senior team. We have assembled a very senior team of senior advisors that are able to speak with the right people in the industry, because let's not forget, especially when it comes to a platform like ours, we don't live in isolation, but we are part of an ecosystem. And in order to develop that ecosystem, you need to have individuals that are able to speak with banks, with insurance companies, with hedge funds, with family offices, with the regulator, with governmental agencies, with corporates, with chambers of commerce, with trade associations, with logistic companies. So it's a very broad range of skills that are necessary, and these skills need to be formed and progress. So I think the secret of success in a fintech like ours, which the fin is really an important part of the word, is to do things properly and without any room for mistake. So it's much better to sit back and say, we could have been maybe a month ahead. The option of saying, wow, we've gone too fast is not one that we should embrace, because it could be catastrophic for the future steps of the company development. The business plan as it stands now, which is the final and ultimate one, which is going to accompany us for the months and years to come, has been in place since January 2017. So I would say that the first year and a half has been devoted to building the foundations for the business. So now we are actually come to the point where it's ramp-up phase. Ramp-up phase meaning that the technology is in place, the relationships are in place, the legal framework is in place, the team is in place, the development team is in place. So the foundations once again are there, and now it's our job to increase volume. So our efforts are going to be focused more and more on sales, getting hold of corporates, entering into partnerships with financial institutions, with larger logistic companies, with supply chains, with a number of introducers who can be conducive to business, and at the same time building on the other side of the ecosystem, which is bringing investors to the platform. In parallel, there's going to be a big push for geographic expansion. And once again, the platform is digital, but it's finance. So finance is regulated. And once again, we embrace regulation, which means we cannot just go to another country and start offering our services. We need to first run a very thorough due diligence on the new jurisdiction that we're approaching to make sure that we can do it. And if we cannot, find tools, partnerships, building a local presence that will allow us to do that. So 2018 will be the volume increase and the geographic expansion for Velotrade, and I think those are going to be accompanying us throughout 2019 as well. So I was an equity derivative trader for many years. I worked in JP Morgan, Dresdner, Bank of America. I then moved to brokerage again in the equity derivative space. The other main co-founder, Gianluca, has a similar background, having done derivative prop trading. And the third member of the co-founding team is Emmanuel, who has 25 years of McKinsey background. So the obvious question is, how can two derivative trader and a consultant come up with such an idea which is specific of trade finance? So the answer is a simple one. We kind of stumbled into it because the world we come from is a world aflush with liquidity. A lot of friends are running funds. We know a lot of asset managers. Even as traders in banks, each time we were pricing complex products, the P&Ls involved were very, very small. So pricing complex structures for just a handful of basis points made sense. And then you look on the other side of the spectrum, and once again you encounter corporates, and they're prepared to pay many percentage points in order to find funding. So a few basis points on one side and many percentage points on the other, there's obviously a massive gap to be met and filled. And so, as I briefly mentioned earlier, we actually started trading on our own account because we found Chinese manufacturers which were able to guarantee extremely good quality control, but were not prepared to issue any credit terms. And on the other side, we had European wholesalers that were desperate to purchase more goods, but had liquidity constraints. So the kind of thunderbolt experience that got us thinking and made us realize that this was an incredible opportunity was the day we went to meet large insurance companies. I'm talking AIG, Coface, Euler Hermes, and similar. And we gave them the list of these wholesalers in Europe, and to our great surprise, they started going through the list, and they realized that, and they started saying yes, yes, no, no, yes, no. And that was kind of a great moment, because we said, well, there's obviously an arbitrage here. These guys in Europe, these wholesalers, cannot get any funding, and on the other hand, the insurance company will actually cover them. Something has to be done here. And so we actually started purchasing goods in China and issuing invoices ourselves to the wholesalers in Europe. And the embedded P&L was massive, because once again there was this massive bridge, and the corporate using these facilities don't think in basis points, they actually think in monetary terms. So, hey, if a container costs 100,000 euros and I can only buy one, I'm going to make maybe 20,000 euros. If I can buy three, I can make 60,000 euros. And if that facility costs me 10, 15,000 euros, hey, it's still worth it. You start working out on a 90-day trade, you're talking of returns that are in the order of 15, 20%, which of course are mind-boggling in a context where rates are close to zero. So that was the idea that got us going, and initially started off as a hobby and a part-time thing, but we realized soon that even though the trade was the right trade, the scalability was not feasible. It was not feasible because we were too involved in the commercial transaction, we were too close to the buyer, to the seller, we had containers stuck at customs, so it was a very educational but fairly painful process, because we could grasp the potential, but we couldn't grow the business at the speed we wanted. So we did about 100 transactions, but realized that it was not that way they were going to build the new thing. So the idea then shifted to creating a fund structure. And so we said, well, it's such a great asset class, so let's collect funds from investors and use those funds to actually purchase invoices. So that was kind of the second step. And the final step, which is the one of platform, is the perfect one, because the scalability of a platform is infinite, and it allows for many and different players to interact through this platform. So of course, given our background in finance, in large institutions, one aspect that you have to deal with, which, as I mentioned earlier, is also one of the drivers of what you're doing, is of course regulation. And the idea is that when you're dealing in a financial environment with large amounts of money under management, and sophisticated players, because we're catering mainly to institutional investors, the regulatory framework is an extremely important one. So there are many ways of going about. There are some startups or new players that decide to either ignore it or downplay it or fight to modify it. But we actually opted for the route of fully embracing regulation. So regulation should not be perceived as a limiting factor, but actually an enhancing factor. And the reality is that when we present our offerings to institutional investors and we give them the regulatory framework that we have decided to abide to, the feedback is extremely positive. So of course it creates some extra work for us in terms of meeting the requirements, but it opens the door to a very smooth and pleasant interaction with institutional investors, and even the corporates who are not regulated and are in the manufacturing world or in service world, but not necessarily in the financial world. Once they see how we have embraced regulation, they are satisfied because it gives an extra layer of security, safety, and we are perceived as a responsible counterpart that understands what regulation means. In terms of the difficulties of this project, the idea is a very simple one. I mean, the concept has been conveyed in a 5-minute chat. It can be condensed probably in a 30-second elevator pitch. So it's a very simple concept, and it's very easy to see the necessity and the usefulness of implementing it. However, the creation of the machine, so to speak, is a very hard one. So it's been a great adventure with a few lows and many highs, but once again, the idea is a simple one, but the implementation is a tough one. I find, as a personal experience, possibly, and I think that's very interesting for anybody who wants to move into entrepreneurship and wants to start their own company, is that throughout the interaction with the external world, what is priority number one for you might not be necessarily priority number one. Often is 2, 3, sometimes 10, 15, 20 for the person or organization you're interacting with, which means that you send a mail now expecting an answer within 20 minutes. Well, that answer might come 3 days later, a week later, a month later, might never come. And so while you are dying to run at full speed, it turns out to be a marathon and at a much slower pace than what you would like it to be. And actually, sometimes I compare it to an ultra marathon because it's often a grind. And the one thing that I notice most is that when you work on a trading floor, you have instant gratification or instant deception, meaning that at 6 o'clock you look at your P&L and you know immediately if it was a good day or a bad day, and you have, once again, instant feedback. When it comes to building your own kingdom, so to speak, the feedback loop is a much longer one, and it's measured in weeks, months, maybe even years. So it takes stamina to get through it, but the result and the final achievements are infinitely greater than any other job within an organization which is already well established. So a bit of advice to new entrepreneurs, especially in the fintech world. It's not pool tables, it's not hoodies, it's not fancy organic breakfast and healthy food. That, of course, is kind of the fun part of it, but it's not the best part. The best part is the end result. And however, I would like to highlight that the trip to get there is not a smooth one. It is a frustrating one. And it depends what your background is. If you work for a corporate, think about it very, very deeply if you have what it takes to be an entrepreneur in a startup, because the challenges are immense. A lot of the tasks that are normally done by somebody within the organization have to be done by you. So fair enough, it's great to go pitch in front of one of the largest VCs or get a great deal through the platform. But hey, if there's no paper in the printer, you have to go to Fusion and buy it. And if there's no pens to write on the whiteboard, well, you have to go buy them. And it sounds obvious and simple, but it's not. Because once again, you realize that you have to build every single brick of the house, and nobody's there to build the parts that you don't feel like or don't want to do. The result, though, is that, I mean, my experience is I've worked many years in large organizations. You get to the end of the year, you have done well or not too well. It's really a personal consideration without really much effect on the global result of the organization you're working with, actually. While when you are your own boss, you can actually turn around and see what has been built. And it's a great satisfaction to see something that was not there before, which you actually created.